That's why a lot of times, don't take this the wrong way how I say this. A lot of times people are like, oh, let's go add that location. Let's go add that location. I would say, yeah, but have you maximized your existing capacity first in regard to production? Because you see the power of fixed and variable.
Right.
Was that too complicated, Bill, or did that
No,
make sense?
I think it makes good sense. And that's where when I say we see some people hit, 25, 30 plus, it typically is bigger practices that have multiple associates and multiple hygienists. It just gives you more people producing revenue to cover your overhead.
Welcome to Dental Momentum, the podcast dedicated to lively discussions on business and financial strategies tailored for dental business owners. At Duckett Ladd, we're committed to transforming your business journey and supporting you at every stage. Join us as we delve into the keys to long-term practice success, from cutting-edge accounting and strategic tax planning to personalized business strategies. Together, let's propel your dental practice forward with unstoppable momentum.
All right, man, let's dive in, man. Episode 6 is 6. Let's round this thing out. What do you say?
I'm ready, dude.
I tell you what, every time we keep going, I think we could just keep adding on an episode and make this like a 13-week quarterly course, if you will.
Try to keep it really high level and simple. But man, there's just so many avenues and offshoots you can do, so many tangents. So try to keep me on point, Jared. I may kind of wander, but hopefully we can bring it home and maybe get some feedback about future episodes and other things we can go a little bit deeper on, because this is, again, meant to be high level, 10,000 foot view type stuff.
Yeah, I love it. So this is our last episode, and this is, again, breaking down on how to diagnose a dental practice from those 4 questions, meaning do you have a production issue, do you have a collections issue, do you have a spending issue, or do you have a combination of all 3?
Right.
What we're doing today is the second part, kind of broke do you have a spending issue down into 2 parts. Last episode, go back and listen to it, we just broke down, I'll say half of the spending, the expense side, which is the cost of goods sold. What comprises the cost of goods sold, what the percentages need to look like, introduce the gross profit metric,
Yep.
gross margin metric, what that looks like, what that means. Today, we're going to go into what we call OPEX. OPEX is, we got these cool slang terms in accounting, don't we? Like
Acronyms,
OPEX
yeah.
and EBITDA and all this fun stuff, but OPEX meaning your operating expenses and what that means. So Bill, I'm going to throw it to you, man. Let's unpack OPEX, operating expenses on your P&L.
You got it. So again, my standard disclaimer, we start at the top, gross production, then you have your write-off adjustments to get to net production. That's what we use to measure production. See if we have a production issue. That's what we think you can collect. So then we evaluate your collections to see if you're collecting well. That creates the top line of our P&L is revenues collections, basically. So last time we talked about cost of goods sold. Those are those variable costs, the clinical associates and the clinical expenses. I say clinical, I mean clinical employees, associates, and then clinical expenses, supplies, labs. And we came up that if we could shake out where your revenue minus those cost of goods sold equals 50, that's your gross margin. That's a really good starting point. And now we move on and we say, okay, in that standardized P&L that we like to use, we have what you said, which is operating expenses, OPEX. Some people call them overhead, whatever you want to call them. Basically, it's these costs that tend to be more fixed in nature. Again, when it comes to clinical cost, as you produce more, as you add ops, as you hire, those tend to kind of go be more variable costs that flow with production. Whereas OPEX, outside of increasing rent or whatever, they tend to be pretty fixed in nature. And what we love about fixed cost is once you kind of get to a break-even point, man, if you can generate $1 over that, it should fall to the bottom line because those fixed costs shouldn't change in conjunction with that. So that's what we like to say is they tend to be more fixed in nature. They're every other cost that goes in with running a dental practice that's not really directly tied with clinical dentistry, basically. We'll get into the exact categories here in a second. But what I will say is, when it kind of comes to low-hanging fruits for initiatives, I mean, this is where true fiscal budgets come into play. Just like you have learned about or know businesses should budget. These are the type of costs that should be relatively easy to budget. They should be relatively easy to monitor to understand if there's budget overages, and to address them. So when it comes to operational initiatives, a lot of times if we don't have a budget, that's the first thing we're going to work for with a client is to get a budget in place or encourage him to do so, because that creates oversight and accountability of these expenses that can get out of hand if they're going unchecked. So they tend to be really solid ways to evaluate them. Again, we'll get into what the categories are here in a second, but we have our gross margin. We take our operating expenses off. We get to our number, which you and I have kind of just come to the conclusion that this is probably the most important number on a P&L, which is that net operating income and where we want that to be. And so, again, like we talked about last episode, and we encourage everyone to go back and listen to back episodes because they build on each other. One thing we mentioned is that we like to see a reasonable doctor compensation, whether it's what you paid your associate or if you're a solo doc, a reasonable production-based compensation number up top. Because if you have that and we get to that 50% margin, then what we really want to see is at the bottom line, we really would like to see that net operating income, gross margin minus operating expenses, at 20%. And Jared, you and I can look at P&Ls and we see them from 15%, 10%, all the way up to 35%, just depending on the practice. So, that is really where we want to be on net operating income. We'll go into the categories in a second, but we really love that metric, net operating income.
Yeah, no, it makes perfect sense. I mean, again, you guys are probably hearing this and be like, I don't see this stuff on my P&L. We get it. We totally understand. That's by going back to the Speed Financial Statement episode about getting this, your P&L outlined like this, categorized by this, allows you to see this stuff easily. And it should stick out, very easily stick out on what your net operating income looks like. So let's do that, Bill. Let's dive into the OpEx side. So if you kind of do basic math there, like you just said, that 30%, this is kind of all in all what this needs to look like. Let's go into what the categories of that, and then what those percentages need to be for each one.
For sure. And these are going to have ranges because it just really, the typical accounting answer, it just depends on your practice. But let's start at the top, which we've already accounted for our employees that are clinically based. Hygienist associates need to be that 20%. Hygienist assistants need to be that 20%. Associates need to be that 20%. And then we really want to keep our non-clinical team, around that 10%. And so what you can see there, Jared, is that's really almost half of your costs are going to be paid out to your providers and your non-clinical team, your people, basically, including your docs. That's why we say that's the biggest part of your P&L and the biggest expense for you typically. But we like to see that non-clinical team, like we mentioned in our cost of goods sold segment, try to encapsulate everything you can in there. You want to get their wages, you want to get their payroll taxes, their 401k, insurance, anything else that their benefits. Make sure those are categorized up there in that non-clinical staff. That's what we call them. Front desk.
So you say they, Bill, like go into who's left if hygiene docs, assistants are up in COGS, like what's left there?
Yeah, so it depends. Solo, you probably have a couple of front desk people. You maybe have a treatment coordinator or someone like that. But, typically like in a single doc, that golden ratio is what? One doc, two assistants, two hygienists, and two front desk. Get to a $1.2 million practice. That's kind of that gold ratio. But as you grow and expand, as we're dealing with emerging groups or DSOs, in that office, those clinical people, that could be 5, 6, 7, 8 seats, depending on if you have like an office that has an insurance coordinator and, new patient coordinator, and they have a treatment coordinator. They have all these different seats that really aren't providing the service, but they are supporting the service. So those are the people there. Just think of it that way. Like, are these people actually either directly working on or assisting people working on teeth? or are they supporting the efforts to get that money collected, to check in, check out, all that kind of stuff? So those are people that we tend to find in that bucket.
Yeah, makes perfect sense. Perfect sense.
So 8 to 10% there. This is one where we tend to see can kind of balloon up. A lot of times, people either overstaff or they staff in anticipation of growing their collections or whatever the case may be. So just like anything, people tend to be ones that will exceed those ratios, even on really good practices. One thing to consider is if you have a family-owned practice, you maybe have a family member in there that is somewhat of a discretionary. They do work probably, but it may be a little bit overly comp. It may be a tax play, whatever the case may be. So that ratio may be higher in that situation. You just have to have that context to know that's why. And in a normalized P&L, you'd back that out.
Yeah, specifically, I was going to hit on that before you mentioned it, was if you got family and stuff, that's probably where they're going to end up being. I looked at a doctor's financial statement, said an event this weekend, and it was like, oh, that's 22%. What's going on? Well, you got 3 kids and your spouse who's not working in there, kind of below. We put all that stuff below the NOI line,
Right.
So that we need to normalize that out.
Right, for sure. So 8 is where we kind of want to be. Sometimes 8 to 10% should be fine there. The next one is probably the most variable cost on your financial statement, and it 100% depends, and that's marketing, sales and marketing. We kind of shoot out a number that seems to be fairly healthy, mix between, not spending a ton like you would if you were, had an implant specialist or emergency dental, but we like that 3 to 7% number. There's people who are so booked up, they have such a stabilized practice that their hygiene is booked out for, a year. They're not gonna spend as much, because where are you gonna put them, right? Or they don't have enough ops or whatever the case may be. So sometimes you'll see that number be really low. Other times you'll see, like in a de novo, that thing maybe 10, 15, 20% initially, and that's part of the startup model, that you have to just plan on budget for that. So this is one we see very all over the board, but again, just in a normal type practice who's really trying to still grow new patients, trying to make sure that they're out there in the community, that 3 to 7% feels like a pretty good starting point.
Yep, agreed. Perfect.
So kind of moving on from that, then we get into facility, and these do tend to be very predictable typically. You know what your rent's going to be. Typically pretty close what your insurance is going to be. So this is really your facility cost. These are your repairs. These are your rent. This is utilities, all those kind of things. That's what we call facility cost. That's what we like to see in there. And that's, a 6 to 7% number. That one, it's funny, Jared, that one almost always kind of works out to around 6 or 7%, it seems like.
Yeah.
I don't know if that's
you might be asking yourself too, like, well, I own my own building, blah, blah, blah. Yeah, but you usually, I say usually, probably should be, but usually, should be paying rent over to that LLC entity you own that in, if that makes sense, to make that note payment. So there's always going to be some form of rent.
And what I will say is one thing I don't know if I specified this, but we're talking about categories here. And if you see your Speed financial statements, you'll see a category that says facility, but then you have all the underlying accounts in there too. And that's so people may be asking like, well, I don't have a facility GL account. I mean, this is a subcategory for rent, repairs, utilities, those kind of things. So if you ever have a question on what exactly, like what an expense should go, we've got some financial modeling that we can share that in our Speed financials, it shows that, kind of what we think should go there. But I just want to bring that up so in case people were concerned about that. But again, these tend to be very predictable, very budgetable. One thing that can get away from people is repairs can sneak up on people. So as you're growing, expanding, you always want to kind of keep an eye on the facility to make sure it's up to speed, that it looks good. That's a big part of drawing new patients and having them have a good experience. Is they don't want to go into a place that's outdated or looks like, something their parents or grandparents would have gone to. It needs to have a modern feel to it. So a lot of times you'll see people will have like to work on capital budgeting and stuff like that. Total tangent outside of what we're talking about here. But, repairs and stuff, those come up and they should be somewhat predictable, and just budget them in and try to stay within that 6 to 7%.
Perfect.
Okay, let's bring it home with the last one, and I guess the last true one in most practices, which is the catch-all. We call it G&A, another acronym, General Administrative. This is like everything else. We've talked about your non-clinical staff. We talked about your marketing, advertising, printing, the design, website, all that stuff. In marketing and promotion, we talk about facility rent and all that stuff. And then we got everything else that goes into it, man. I mean, we got the credit card fees, bank fees. You got your professional fees, whether it's accountants, attorneys, computers, all that kind of stuff that goes in. This is a big catch-all, and admittedly, we understand that you got to have something that catches everything else. That's why it's called general administrative. This is something we also like to see around that 6%. So just kind of as an interesting aside, when it comes to budgeting, when we're having our monthly financial reviews with folks, what we try to do is we look and highlight certain categories that are off, and a lot of times it's G&A, and that's where you want to dive in really and understand, why is it off? What specifically is going on there? Maybe it's some continuing education expenses that we weren't planning on. Okay, at least we know, right? So this is one where you really need to set a budget in place. You need to monitor it. You need to make sure that it's like clinical supplies, man. It's easy to, if you have a credit card, a divvy card, whatever the case may be, for them to just put meals, all kinds of stuff on there. So just a little bit of oversight can go a long way on these other costs here, and a budget's the first place to start on that.
Yeah. So guys, that's kind of a breakdown of what's included. Bill, you said it perfectly. Like, if you're listening and like, well, hey, what about this, that, and the other? Like, where would that be included under these subheadings? Yell at us, right? We can give you a sample P&L of what makes those categories up, if that makes sense. But all in all, kind of getting to where that OpEx in the aggregate, if you will, kind of gets around that 30-ish%. And I would agree with you, Bill, like, the marketing is the biggest fluctuator for the most part, where it can move several points here or there, just like your speedometer, right? It could go up, down, based on what your needs, wants, growth goals.
Exactly.
All that stuff plays into it. So
just some real quick bonus content too.
For those of bonus content, baby.
A little freebie here. One thing we haven't really talked about is, this is really to get to that 20% net operating income for a solo practice. Mm-hmm. When it comes to emerging groups, a lot of times they start seeing corporate expenses. They may start paying consulting, they may start paying fractional CFO, or they start paying themselves CEO draws, those kind of things too. So just a general rule of thumb we've seen as we worked with really good groups is, as they grow and scale, what you really want those numbers to stabilize to, or what we think are good numbers to stabilize to, is around that 3 to 6% for corporate type expenses. What I will say is, if you're just starting your journey, that number will be a lot higher. You'll see a lot higher percent allocated to your corporate type expenses, those centralized type costs. But a good goal would be to say, can we get to X, where this ratio is now 3 to 6%? With our current infrastructure we're building on the corporate side. So again, a lot of times it takes a while to grow into that 3 to 6%, but upon stabilization, a lot of our great clients, that's kind of what they're looking to spend on corporate there. And a lot of times they try to get where they still hit 20% after corporate, so they're going to have to kind of squeeze the margins elsewhere. But again, just some quick bonus, if you have groups that have some corporate spend, that's a good goal, is to try to get to that 3 to 6% spend.
Yeah. And maybe what we could do, just emphasizing the point about variable and fixed, I guess we can try to do this on the fly. Let's wing this thing. So let's use easy math. We're accountants. We're not good at math. We're good with calculators, but not math.
Right.
Let's say you've got that $1 million practice, mm-hmm. $1 million collections, right? You're bringing that in on an annual basis. And let's say you are hitting these numbers that Bill was going through in this episode, and you're going to have to go back and listen to the prior one if you haven't. But that cost of goods sold number, let's say that is 50%. okay, and your margin's 50%.
Mm-hmm.
And you're a single doc practice here, so you are including a reasonable comp for you in there, right? Let's just say it's that 200,000,
Yeah.
which is that 20% number.
Yep.
And let's say you are, a lot of ifs, ands, or buts here, but you are running 30% OPEX. And so your NOI is 20%.
Mm-hmm.
Okay, 200 grand.
Yep.
So you as that owner doctor, single owner doctor here, you're making your NOI of 200, and in theory, you're making that 200 for your clinical comp. So you're 400 compensation.
Yep.
Now, here's the power, and a lot of ifs here, but here's the power of adding a provider if, and this is the big one, if you have the capacity in your existing location to do it. Right? You have to have the ability to expand into ops that you either have plumbed out or can plumb out and all that fun stuff, right? So if you have the capacity to do it, you can add another provider, okay, maybe another hygienist with it. Let's just use easy math here, another doctor. And they are able to come on and over the course of time, get to where they're producing, let me just pull a number out, 800,000 of production,
Mm-hmm.
okay? That 800,000 of production, in theory, if you're able to keep your cost of goods sold and margin in place, their 800 of collection should be producing, if you will, let me use a different word, generating $400,000 of profit, right?
Mm-hmm.
In theory, your OPEX should stay fairly fixed.
Right.
Now, I will argue maybe, well, Duckett, I mean, you're going to have to ramp up marketing a little bit to increase new patient
Fair.
flow to get the production for the new doc. I get that. Your facility should stay fairly fixed because you're still in the same place, maybe have additional payments or whatever if you had to build out those ops and that sort of thing. But choose in a perfect world, if that stays in place, meaning that 30% number on the million, right? And I hope I'm not confusing people, but it was 300 grand of OPEX. If the 300 stays in place, that additional 400 of profit generated by that production should go to the bottom line. And so now your 200,000 of NOI, the 20% of the existing million, now turns into 600,000. Did I do my math right?
Mm-hmm.
600,000 of NOI on 1.8.
Yeah.
Now we're what?
30%.
I can't do math, but 30?
Yeah.
Yeah. So you see the power? That's why a lot of times, don't take this the wrong way how I say this, a lot of times people are like, oh, let's go add that location. Let's go add that location. I would say, yeah, but have you maximized your existing capacity first in regard to production? Because you see the power of fixed and variable.
Right.
Was that too complicated, Bill, or did that make sense?
I think it makes good sense. And that's where, when I say we see some people hit, 25, 30 plus, it typically is bigger practices that have multiple associates and multiple hygienists. It just gives you more people producing revenue to cover your overhead. That's just the way I look at it. When it's just you and maybe two hygienists or you and one hygienist, your margins are organically going to be leaner. And again, what I will say is don't interpret this stuff to say that just go build out a strategic plan to hire an associate tomorrow. I mean, this is a very strategic move, and one that what we will also say on the flip side is if you hire someone too prematurely, you're going to create a lot of confusion and delay in your practice. I can promise you that, because they're going to be frustrated. Your patient's going to be frustrated. Your team's going to be frustrated, and you're going to be frustrated because you're probably going to be making less. So in a right move, you're exactly right. That's how you can get to where that 20% goal becomes 25 to 30 plus. It happens. We see it all the time but it's usually in those bigger practices who have associates, and not just associates, but associates who do not have a production issue, who are out there producing and making good money for themselves, but also allowing you to cover more overhead and bring more to the bottom line, and ultimately drive more NOI, which also leads to valuations and so on and so forth. So done well, it's a huge advantage. I mean, it just is. It really helps you hit those numbers even easier.
I'm glad you said that and put that disclaimer on it. Like, oh, listen to the Duckett Lad episode 6 of 6, and they said, go ahead and add an associate because I'll add 400K or whatever to my bottom line. No, I love what the DEO says on this. I'll shout them out a little bit too, because they go through that launching profits, optimizing profits, then duplicating profits. Duplicating not adding locations, but duplicating it in regard to adding providers. You realize what happened before duplicating, optimizing,
Right.
making sure you've got your existing space optimized. You're hitting this metrics, and certain things are now in place to allow you to duplicate and go forward. So I'm glad you said that. Little disclaimer on that.
And let me give you one more little thing I've learned over the time. Which
Bonus
I think
content number 2.
Bonus
right
content
here. Bonus
number
content
two.
number 2.
Real quick. One thing I love NOI, called net operating income, but it's almost, I think I learned this from Ken Kaufman or somebody, but when you start having multiple practices, just a quick shift of lingo to change that to net contribution margin just makes so much sense to me, because that's like, if you look at net operating income for one practice of say 5 or 6 or 7, in effect, that's what that practice is contributing to your portfolio's net operating income. And I just think that's an interesting mindset change, because then you can see if you got 20%, 20%, 25%, 20%, 6%, okay, you could see outliers of practices that need work. And it can almost always circle back to have a production issue, do I have a collection issue, do I have a spending issue, or do I have a combination?
That's perfect, man. So kind of round this thing all up, and it's tough to do this in whatever time this is going to take, but high level, right? I mean, it's just go back to think through our episodes here. So speed financial statements. You really can't do any of this that we're talking through until you get your data
Right.
formatted in the right way.
100%.
That's first and foremost. So if you're hearing this episode, like go back and listen to the speed. What the heck speed? Bill does a great job of explaining what speed financial statements is and what the format we think makes the most sense to look at, right?
Yep.
And then just work your way through the questions. I mean, Bill did an amazing job of, do you have a production issue? Well, I don't know. Let's see. Go through the different questions he asked. Like what metrics, we like to see to say, yeah, I think we have a production issue. And now I got it all figured out from the production side. The next questions are my issue, right? Go through the next question. Collections issue. Am I collecting what we produce? Probably, like you said, Bill, the easiest way to, if you got points there, to find those points.
Yep.
To dive in.
Exactly.
And then the spending issue. We kind of broke that down between COGS and OPEX. Again, you said it. I love what you said, Bill. You can't, they say you can't save your way to profitability. I would probably agree with that, but it's a great place to shave some points
100%.
if you're spending.
Yep.
And the spending really shows where there's sometimes production issues, but, and then just what your NOI is, right? And I think probably the hardest thing after you go through that, and Bill, we won't go on a tangent here. This could be another episode or whole series, but like, then where do you start, right?
Yes.
You've kind of gone through all that. Like, yeah, I've got a little bit of a production issue, maybe a harder or bigger collections issue, and my spending's a little out of whack here. Now what? That's maybe another episode, but what's next? How do I fix it? And what plan do I put in place to do that? You know what I mean?
That's the beautiful thing. Interplay of ops and finance is finance brings data, objective data, and collectively you create initiatives to try to fix it and create a system of accountability. I think we could definitely do an episode there. What I will say, Jared, is our goal was to educate, and I think we have some tools that people could have access to if they ever need them. If they ever want to see a sample financial statement that shows how we break it out, happy to do that. And also, this has kind of been working towards a scorecard that we have that we can make available if people want to kind of just do a quick analysis of their practice and see where they're at. And so those should be available as downloads if anybody wants to take a peek at that.
Yeah, 100%. I'm glad you said that before we stopped recording this, because education, we have an educational heart. That's what we want to do. We want to educate people on how this works, how we see things. If you have questions as you're listening to this, however, wherever you're listening to it, on Apple Podcasts, Spotify, whatever, shoot us a message back. If you're listening to this on YouTube, whatever, drop a comment. Like, what about this? What about that? We see that stuff. We'll get back to you. We can share that downloadable, scorecard. So you can just do this yourself. I'm glad you said that, Bill. Do this yourself. Fill it out as you go through and see where you're at. The goal is you can't get better until you have to figure out where you're at, then where you want to go. The hard part is in the middle. that's where it comes in, where the hard work gets. You roll up your sleeves and get after it. And that's what we're here to help on. So, Bill, I appreciate it, man.
You bet, man.
I mean,
It's
we
fun.
might get a side gig of some educators at the local local university, right?
Yep.
Maybe I think this might be the only topic I could teach on, though. Like, I think I got a C in econ. I couldn't teach econ or
You gotta have
psychology
something
or
you're
anything.
passionate about, man. You have something that you get fired up about. I know we do on this stuff, so maybe we're nerds, but hopefully that's helpful to people. And any comments or questions, send them our way.
I love it. Bill, appreciate it, buddy.
You bet, man. Talk to you later.
See you, man.